Hey traders, Stephen Kowitzel here with thetradersplan.com. It is Thursday afternoon, about midpoint of the day. We're going to go through, I got a couple of announcements to make before we go through lots of charts today. One, in the email that I sent you with this market update webinar, there's a survey. Your feedback is incredibly valuable to me, and these are anonymous surveys. So I can only get better based on the feedback I receive. So if you would take just a couple minutes to fill out the quick survey and tell me, what you would like to see, how I can improve. I would most certainly appreciate anything to webinars or my service. So I would appreciate you to take the time to take that survey. Another thing, my good friend Matt Morris with Microcap Millionaires, he's actually a personal friend of mine. He's been to my hometown in Arkansas. We know each other very well. He actually got me started in this, helped me launch my stock market newsletter. I am trying to have him on as a guest. He has a really, really neat, really innovative option strategy that I want him to come on and teach us. I couldn't get him. He's super busy, so I couldn't get him on this week's market update, but I plan on having him very soon in the future. So I'm going to send out something this weekend so you can learn a little bit more about his option strategy. Since I'm not an option trader, I still like to put that information out there so you can learn it. So be looking for that. I'll probably send that out on Saturday and Sunday if you are interested in this option strategy he's doing really well with. Okay, let's after the announcements, let's get right into the market. You can see, boy, we have a strong day, especially in the small caps, Russell 2000. Everything's just, looking all hunky dory. Let's before we dive into the individual indices, let's look at some of the sector spiders. Actually, I want to go into the sector summary. So, forgive me, give me just a second. We'll get there. There we go. So the sector summary. So, it's kind of a mixed bag and it's kind of odd. Yesterday, I almost invested in some energy, but I'm not very impressed with the bounce. So we're going to look at that. But if you look at what's going on today, staples are leading, and yesterday utilities led significantly. So even though utilities are on the bottom and technology and materials are bouncing in consumer staples, a defensive sector is still leading on a day when the market is really strong. And given what utilities has done over the last week, I would just be cautious. There's only so many breakouts that the market can have to the upside. So we are in a bull market, but just be cautious a little bit, as I am. So let's look at what has happened in the last 1 week. You can see consumer staples has moved up the ladder a little bit, and utilities had a big day yesterday. So you got staples towards the top, cyclicals, but staples with the percentage change over the last 1 week is dominating energy and is dominating everything, and energy is definitely pulled back. If we go to the 1 month view, technology is still dominant, right? So there's everything really still looks good in technologies, although some of the leaders are starting to get hit. So, I've talked a lot about financials and energy because I feel like, these institutions are going to rotate into some of these more cheaper, more affordable names, because that's just what institutions do. And hasn't been as much on the up as technology lately, so I think there's more room to run in some of these other sectors. But plus, I look at technology stocks, and there's not many of them that haven't just quadrupled in the last year and a half or so. So I try to get things that are a little early in the move. So just kind of be cautious that staples are leading today. And as always, this is if we look at the Nasdaq, we want to make sure the market finishes strong for the day, because we don't want it to be a big day the first half and then fall off a map. That means it's coming into some selling pressure. Let's look at here. We'll just kind of look at the Nasdaq. Let's start with the Nasdaq a little bit. And, there's really nothing to complain about. It's just really been a nice 45-degree angle on the upside. It's breaking out today, and I believe it's 68. It's right now, it's at a 52-week high or an all-time high. Lots of distribution right here, but that doesn't mean the market can't head higher, because you can see it's smooth right here and then it gets a little sloppy. So, with this distribution, even though it is breaking out today, but the fact that staples are leading, I'm just going to keep my eye, and every time I take a trade, I try to ask myself, where's the market going to shake me out of this trade? How are they going to take my money? So I just, maybe you ask yourself that, and to try to make sure you buy stocks that aren't extended, that are close to support, like moving averages or something like that. So you can see that all these other breakouts, they seem to work just fine. This broke out, this breakout, and now we have this one. So, we're heading into an incredibly bullish part of the year. So we could just have a blow off the top last couple months of the year. And then we'll kind of see what happens. But, the S&P 500 really looks the same. Even though it's not at a 52-week high, it's breaking out of this downtrend. It's just incredibly bullish. One thing, just to kind of keep an eye on is sometimes it's really harder to make money in the market when the major moving averages are below their 20-day moving average, because that's really the trend, and that's a sign of healthy intermediate to short-term positive uptrend. So when it starts to crack a little bit, just be cautious, and it can just come back and, shake everybody out and get right back up there. But, if it starts to kind of flounder a little bit and doesn't continue to, follow its path like it has all these other ones, I would just really be cautious. A pause is very, very reasonable. And this might be all the pause that we get, because it's just, every pullback's been 2 to 3%, and you think it's going to be the big one, and not so much. Small caps, you can see are really turning up relative to the S&P. I mean, it is charging forward today, and you can kind of see you got this almost foghorn type of consolidation right here, this flag. But it broke the 50-day moving average, and then is trying to break out of this downtrend. So it, in my opinion, is still in the flag. It looked like it was breaking yesterday, and maybe if I drew the trend line a little bit differently, one could say it did. But every time I think the market's just going to crack wide open, it just reverses and go higher. Just like it did down here. You thought that the market was going to go down, it was going to break all these support lines, and then it just went on a 15% tear. So don't sleep on the market, and don't have what I call it's the big one-itis. And that means that every time that the market starts to pull back, you think the big one's coming, and you start to sell everything. You have to stay with the trend until proven otherwise. And I understand that sometimes that can be a little difficult for me too. So I want to look at the 10-year Treasury yield right now, and this is a long-term chart. It goes back to 99, and this is the weekly chart. And I think looking at Treasury yields right now, looking at interest rates, are incredibly important for the market, along with the dollar and a lot of the other intermarket relationships. But you can see that, I mean, it's been in a downtrend. It's really been in a downtrend since 1981 when Reagan took over. But this looks bullish, right? This is a nice, straight up off the bottom bull flag breakout. Now, what happens right here, and this is a longer term picture, is incredibly important. I was watching a webinar with Martin Pring. He's got some amazing, very, very long-term views. I'm talking going back to, the 50s or the 1900. But, basically he showed enough evidence to show that interest rates, when they're bottoming, when they come out of a 20 to 30 year bear market or bull market, and they're trying to reverse course and go the other way, it is not a V shape. Not by any means. So it might look like a V shape if you go to an annual chart, but if you look down at the weekly and the monthly, it will just shake the bejesus out of you. So what I mean by that is, like, even though this looks bullish, there's enough evidence to show that this could flounder around for another year or so before it really starts to just turn around and go upwards. I do think it's a really good long-term play for banks and interest-sensitive investments. But, and this looks bullish right here, but what happens here? Is it going to follow through, or is it going to kind of crack and just shake everybody out? I don't know, but all I'm saying is I've seen enough evidence to show that there is, at the turning points, at the major turning points of interest rates, whether on the upside or downside, that it could be volatile and shake everybody out. And so just be really cautious of that. Down here is a correlation between yields and financials. You can see anything above zero is positive. So for the most part, Yields, financials, the banks, the brokers are, when the yields are going up, the banks are going to outperform, which is a positive for the overall market, and vice versa. If the yields go down, that might send banks down another leg. Which to me, if that happens, that would be a tremendous opportunity for your favorite banks to take a 10 to 20-year hold on them. The yields are also negatively correlated with gold, especially lately. The last couple of years, you can see that it's just completely inverse. So if yields just continue to rise, then that's probably going to keep our precious metals down. But if yields don't, and there is frustration for the yield bulls, it could be extremely positive for gold, and gold is knocking on the door of breaking out. So it's just, you always want to pay attention to these intermarket relationships, because they can give you early signals of what one is going to do versus the other, and tell you where you want to place intermediate to long-term money. I want to talk about some emerging markets, and I always come back to emerging markets. I've been talking about it for years. Actually, before I do that, I want to talk about the breadth real quick. You have the S&P 1500. You've seen this chart before. You have the S&P 500 mid caps and small caps. If you notice, this is the percentage of stocks above the 200-day moving average. When the small cap breadth gets below 60, the market tends to correct. Or at least be in some kind of, let me kind of update that. Be in some kind of sideways pattern. You can see right here that it was chopping around under the 60 mark, and the overall market, the gray line that I'm following, was definitely in a downtrend. And then it went below the 60-day mark in May, and you can see the market pulled back right here. It was a very quick pullback. And same thing right here in August. You can see that right here, August pulled back, and sometimes this can be an early sign. So when you see that happen, which we're very, very close, just be cautious. And when you have the market breaking out and staples are leading, that's also a reason to be cautious. Now, every time I say be cautious, I swear the market just turns around. But, right now I'm looking for how can the market shake me out? And I'm not trying not to get too top heavy. If you want to know about a trade that really keeps me up at night in the long term, it is emerging markets. Now, I have this trade, and on the weekends, I have plenty of time to think about, where over the next 5 to 10 years do I think the money is going to significantly outperform? And I keep coming back to emerging markets. And when I break down the emerging markets, I keep coming, because that's where the growth is. Whether we can sustain or get 3% GDP growth in the U.S., that's all hunky-dory, but the reality is some of these emerging markets are growing at 6 to 8%. So I think that, their stock markets can be significantly trump, no pun intended, the U.S.'s stock market. Now, you want to wait for signals, right? You don't just want to say, oh, I love emerging markets, let's just buy everything and hope for the best. But you have some of these countries, the ones that I'm really interested in are the countries that have extremely high GDP growth, and two, have an extremely high percentage of their population that's millennials or young. And what that means is there's plenty of people to enter the workforce coming out of, college and things like that. And a lot of these countries with high GDP and a high young population, their growth isn't going to be hit hard as, a China by an aging population that a lot of the younger generation is going to have to fund their retirement. So I feel strongly about this, and I swear I think about this all the time, and I try to mention this to my wife, and she doesn't care. But so that's why I'm sharing it with you. So you got the Philippines, they just came out with like a 6% growth. So I'm just going to show you some ideas, and I am in the process, probably within the next month or two. If I had one theme mutual fund, it would probably be these over the next 5 to 10. It would probably be these emerging markets with high GDP growth and a high percentage of millennial population. Just because I've looked back at these stock markets and when they're early in their move, what they can do. So I look at the Philippines, right? The Philippine composite. And if we just look at this is just the actual stock market. And from 2003, the stock market was at 1,000 and now it's at 8,700. Well, that's an 8-fold gain. That's a lot more than the S&P 500. So you're not going to catch all that move, right? It's just not going to happen. But if you can play a simple death cross, golden cross rule, where the 10-week crosses above the 40-week, you're in. When it crosses below, you're out. You'd be sitting all right. You had a 300% move in 4 years right here. You had a 400% move in about 5 years right here. So these markets, when they get going, they can move, and they can move a lot quicker than the S&P 500. And really, since the commodities peaked back in 11 and 2012, emerging markets have underperformed, and emerging markets are starting to take way. But this is a relative ratio versus the S&P 500, so you can see since 2002 to 2013, emerging markets, it's just smoked. This is a relative ratio, so if its lines going up, it outperformed the S&P 500. It just smoked the S&P 500. Like it's not even close, and has been underperforming since 2013. Well, I'm looking for breakouts of these relative ratios. Now, these are weekly charts, so they might be a little lagging, but when these get going, it's a place you want to be at, and probably not a place you want to swing trade it. Probably a place you kind of want to close your eyes and see if you can hold it for a little bit longer, because they are volatile. So, I talk about the Philippines. I like Pakistan, no matter how you feel about the Middle East. But let's kind of look at the same chart, but the I think it's called the Karachi Stock Exchange. A lot of these places are starting to come online, like you got the Pakistan ETF. Now, this Pakistan market is in the death cross, so you just want to be out. But you can see right here that this market in, let's just say 2002, kind of compared to the Philippines, was at 1,000, okay? And now it's at 53,000. So that's like buying a stock for $1 and watching it go to 53 bucks. I mean, that's just nuts. And that's the kind of, with the globalization, a lot of these ETFs and opportunities to trade some of these markets are coming online. So, and Pakistan is, a country that has high GDP, high millennial population. So, you can see in 4 years, this index was up 656%, and then you had the death cross, so you had a sideways. And then it went 19%, and then death cross, 2008. You'd have been out up here, you'd have been back in down here. So you missed most of that. And a 58% move, and then correction, 172% move, and then correction, and 53% move, and then you're out. And this is long term, right? This is not, I'm going through it quickly, but I'm just really trying to prove a point. If you buy a stock for $1 and it goes up to 53 bucks, you're going to be pretty happy, and you're not going to catch all the move. That's why just a simple golden cross, 10-week over the 40-week, and you're in. 40-week over the 10-week, then you're out rule. It was really good. And I plan on building a basket of ETFs for my subscribers, for the paying subscribers at least, and launching a thematic portfolio for this probably in a couple months. But I really kind of want it to pull back, just because they're all really extended, and I want to kind of get in what I think is a really good entry. So you got Pakistan, you got the Philippines, you got India. So I'm just going to go through 4: Pakistan, Philippines, India, and then I'm going to go through Vietnam. So same thing with India. You got the exchange. Let's just say in 2002, it's at 3,000. The market's at 3,000. Now it's at 33,000. So it's up tenfold. That's pretty crazy. If we go down here to look at the relative ratio versus the S&P 500, it, over the same time period, until middle of 2010, outperformed the S&P 500 and underperformed the last 7 years. It is getting close to a breakout where you could potentially get one of these over the next 10 years. So these are just long-term ideas, but ideas I believe strongly on. And you can see this SMIN, that's Sam Mother Indigo Nectar, versus the S&P 500. It's already broken out, and it's already outperforming. So another one that is really, really starting to get strong, Vietnam. Look, it's now stock charts did not have the Vietnam Stock Exchange, so I couldn't show you that. So I can only show you the ETF. But look, it broke out relative to the S&P 500. and it is looking really strong. It's up, from 12.5 bucks to 16 bucks. I mean, that is a steady uptrend, my friend. I'm waiting on a pullback, and I'm kind of frustrated that I'm not getting it, but I mean, it might not give me an opportunity. So, I mean, this is just what I'm talking about when you get that really, really strong power. And I'm not telling you to abandon the U.S. because, I mean, obviously that market's been strong. All I'm just saying is, if you're going to look outside the U.S., why not go after some of these countries that have huge GDP and huge young populations that are, because I've looked at charts of China in the 80s and, back when they weren't quite hampered with the aging population like they are now, and they go parabolic, and that's kind of the move I'm looking for. So that's just kind of something to keep in the back of your mind if you want to know what's in the back of my mind every single weekend when I kind of step away from the markets and I try to say, okay, what kind of theme do I think could just really outperform over the next 10 years? This is kind of what I keep coming back to. So just something to ponder on. Now, I wanted to show you this this chart. This is just an Excel spreadsheet. Excuse me. This is just an Excel spreadsheet of some of the most recent trades for this weekly reversal strategy. So a lot of you have came in and followed me through the weekly reversal strategy, and you've learned it, and it's a bottoming pattern. We can go through that in a minute, but I wanted to show you something. And what I'm in the process of doing is I'm really tracking the trades to see, okay, what the win percentage is, what the loss percentage is, what is the best profit and loss taking zone for these trades. So normally I am, when I make a trade, I like to, sell half at 8% and raise the stop to break even. Don't plan on doing that for this strategy. And the reason why is because I get so many signals that I give to some of my paid members. I get so many signals that it's not really possible to own them all, right? So I don't want to, if I sell a bunch at 10% or 8%, at least the half positions, I don't want to own 15 positions. So looking at all of these charts and studying them, what I thought the best way of this swing trade would be, when you come across a signal, and I email them to you on Monday, you enter the trade and you put a bracket on the trade for a 10% profit or, a loss, and you got to put a stop loss in there. So what a bracket is, and if you've seen the 5 Cornerstones course that's in the members area, you've seen me show you how to set up a bracket. And what you do is, after you place a trade, you can go in there and say, okay, I'm going to make this mechanical as possible. I'm going to go in and place sell it when it hits a 10% gain, or I'm going to put a stop in it at the same time. So that way, if it's going to automatically trigger me out on the upside, it's going to automatically trigger me out on the downside. So, and what I did, and you put a stop loss 1% under the previous week's candle. So when you get that flush out candle in the pattern, you put a one, and let me kind of bring one of these up, just to kind of show you. Here, we'll kind of look at this, Williams Sonoma. We'll just kind of look at this, WSM. Actually, let me look at this right here. Just to kind of show you what I'm talking about. So you have this weekly reversal candle right here. I can see it clear as day. And then you buy at the open on Monday. And then you put a stop loss at 1% under the prior week, right? Because you're putting the stop under that candle, just 1% under 42.36 right here. Or you're putting a profit target at 10% above the open on Monday. And that's your bracket. And it's really simple as that. And you can call your broker to help you place that. So when you put these brackets for a 10% price target or a stop loss 1% under the candle, this is the results that came from it. Out of the last, now there have been more trades, and I'll explain this to you here in a second. Out of the last 21 closed trades, now I'm going to repeat, this is the last 21 closed trades, meaning they hit a loss or they hit a win. So the average win, there's 17 wins. The average win, and these are picks that I've either given you or I've given most of them to the paid subscribers. But out of the last 17 wins, there's an 81% win ratio, average win of 10% because we're cutting them all at 10%. 4 losses, and the loss percentage is 19%. So you got 81% win ratio, 19% loss ratio, with the average loss about 10.6%. And why it's the average loss is slightly more than the average win because I don't do a straight 10% stop loss. I make sure I put it 1% under the previous week's candle. So I'm showing you this because I'm continuing to watch it and try to find good, and I know you see a lot of charts out there where I talk about this pattern. I'm trying to show you a good swing trading strategy for these stocks, and instead of selling half and keeping half, I realized that since there's so many signals, the best thing to do is just place a bracket on it where you take profits at 10%, all at 10%. Now, obviously, if you want to do something different, that's your prerogative, that's fine. And then just place the stop under the wick. And these are the kind of results you got. Now, I am still currently in 11 positions. So that means out of all the signals, in addition to this, these are the closed trades. I have 11 open positions. Yeah, I'll be putting this in my members area as soon as I can get in. My AT&T was down yesterday. I think that has to do with my WordPress today. There's been problems nationwide, but so those 11 positions haven't hit the 10% price target or the stop. And my goal is to really give you a pond with those open positions for the members. I'm really trying to give you a pond to fish in. That way, if you're looking for more signals, you can go to this list and say, okay, these patterns have happened. Here's where they're at now, and I can put in my bracket trade for a swing trade. So this pattern, the weekly upside reversal, and I just kind of want to go through it again for those of you who are unfamiliar with it. What happens is three simple rules, really, and let me kind of drop this this volume to put below price. That way you can see the candle. So you're looking for a low point on the chart. You're looking for a undercut. One, it's got to be a previous downtrend. So rule number one, you're looking for an undercut of the previous week's low. Here, let me get this off. So you're looking for an undercut of the previous week's low. That's one. You're looking for a close above the previous week's close. That's rule number two. And you're looking for an above average weekly volume candle. These are weekly charts. And then you buy at the open on Monday, or you can buy like right at the close on Friday if you know it's going to complete. So it's really an extremely simple pattern for buying stocks at the bottom. And I just wanted to show you the results of what I'm sending people. So if you want to constantly have that pond to fish in, you can at the bottom of the email you can hit join the newsletter, and you can take a trial there. But I'm trying to give you some education, and I'm trying to give you a way to continue when enter, when exit on the up and the downside. That way you have a game plan. If you do your chart studying on the weekends and you identify these patterns, you can buy at the open, sell at 10% gain, or put your stop in. But put your brackets in both at the same time, because our goal as traders is to take the emotions out. And when you use a bracket and you go ahead and place those orders right after you buy it, you're making trading as mechanical as possible. That way you can't sell it unless one of your triggers automatically happens. So you buy it, and then you're stepping away and let the market do whatever the market does. So I hope that was helpful. Let's go look at some gold, some oil, and stuff like that. That sounds like fun. By the way, I'm having all kinds of technology problems. I hope my microphone sounds okay. I'm using my different one. Let's look at GDX for a second. So you have gold GLD in this box right here, and you got the head and shoulders breakout, and then it came back and possible failure breakout. It's really just chilling around this breakout zone. Gold is. So if Treasury yields take a leg down, I think gold will turn up, and that's just kind of something I'm keeping my eye on. And when I look at gold miners, I look at this downtrend, and it broke out, came back, tested support, took off, came down, tested support again, and then kind of rolled over. But it's still in this zone, right? There's not when you're dealing with ETFs and baskets of stocks, there's not an exact price, because each stock has its own support zone, right? So you're really just looking for the area. It's not going to find support at the moving averages as well as an individual stock will, because it's just too hard because that would mean all support zones on all stocks in the basket of ETFs are exactly the same, and that's not going to happen. But it's still chilling right in here. So I mean, I'm still looking for that breakout. I'm just not going to enter until that happens. And that's how I feel about it. But you can see what's happened in the dollar, the UUP in this purple. It has been in a downtrend, and it looked like it was a counter trend rally, and that trend line has already broken. And that's kind of telling me that I'm confident this will break out, but it still has to happen. Because if it doesn't happen, that's going to make me suspect of the dollar breakdown. And what that means is, so if the dollar starts to curl around and it comes back through this trend line in the positive side, you know, one thing I learned from, actually it was Martin Pring again, he said, okay, when a trend line breaks and it's a false breakout or breakdown, it's going to be an above average move in the other way. So if gold turns around and this is a false breakdown, it's going to be an above average move, and that means that this probably isn't a counter trend rally. It means it's probably going to move, which would be bad for gold. So this has to break out for me to want to get involved, and just, you know, just looking at it. I don't like to jump the gun. I wait for a double confirmation. Looking at XOP, this is the oil and gas exploration and production spider ETF. Okay, so you got oil that went to 57 bucks, West Texas, right? Looking good. Broke out, everything looks bullish. It's pulling back, which is, you know, there's nothing wrong with a pullback. Everything needs to take a breather. You know, here's what I'm keeping an eye on. So you got the ETF right here. Pulled back to support. I entered, sold right here, which sold it on the perfect day. And then it came back, and is you can see the 10 weeks trying to, or the 50 days trying to move above the 200 days. So it could be a golden cross. Here's why it's kind of got me scratching my head a little bit, because I don't mind this kind of pullback, but this is a waterfall. I mean, it's just nailed 3 days in a row in a bad way, and then it hits support. I don't like pullbacks that are that hard, so I'm watching this. I'm probably not buying this pullback just yet, just because this is a really steep drop-off. And normally, if it's that steep, at least I've learned that that there could be more to come. It could pop up and then roll over. Now, if I'm wrong, this is the best entry to get in, because you got the 50-day moving average, 200-day. You got trend line support. If I were to draw a trend line, you know, everything's looking right. But this waterfall has just got me scratching my head a little bit. So I'm a little cautious right now. It's just got me cautious. So I'm just going to watch it for a few days. And if it holds, I'll probably be good. And I might buy some oil stocks. But it's just a little steep for me. A little steep for my blood. Let's look at some individual charts. Let's see where we want to go. You know, I was talking about some REITs last week, and I noticed that a lot of these REIT companies or real estate development companies, I mean, they're worth paying attention to. So I'm looking at this Marcus and what was it, Millichap? Don't know if I pronounced that correctly, but it broke out of a nice downtrend right here. But look at this volume stepping in. Now this is a little bit extended, so you might want to wait for a pullback. But you know, there's volume coming in REITs. There's volume coming in these real estate development companies. I don't know if that's a defensive play. It's kind of got me thinking that it is. Money's moving in defense. But real estate development, I wouldn't necessarily call that a defensive play. So maybe there's just, you know, real estate needs you know, some time in the sun for a little bit. And so that's kind of what I'm waiting on. So, but this is an interesting stock, and it's got absolutely nailed, and this just looks ugly. But now you have the golden cross, you got the breakout of the downtrend, and you got the volume stepping in. So this MMI, this is kind of looking interesting. No, I don't want to say that. Kind of brings me back to the cube that I showed you a couple weeks ago. It did have a weekly upside reversal. Right here, you can see that. See the candle? It was in a downtrend, and then it's candle, and then it popped, but then it's gone straight up and hasn't looked back. So maybe this is gonna pull it back a little bit. But you know, look at the volume. Look at the volume stepping in right here. This is a REIT, and REITs don't have just fundamentals that are just superb. But you know, maybe there's something that I'm missing. But what I'm not missing is the volume that's stepping in some of these REITs. So it's just really worth paying attention to. Yeah, look at another stock. Actually, no, wait a minute. I had this chart saved somewhere. Fitbit. Okay. So Fitbit, I mean, it was a Wall Street darling. And it just, sometimes it kills me. Some of these stocks that come out, and they come out with just these tech stocks, they come out with astronomical valuations. I don't really care about valuations. I care about price action, but they come out with some ridiculous valuations, the IPO, and then the problem is when they stop growing at the clip that Wall Street is pricing in their stock, I mean, they are getting nailed. But with that being said, after they get nailed, if they can figure things out, there's tremendous opportunity. So you got Fitbit. It is this bottom rectangle first stage pattern. Clear as day, you can see that. There is no denying that. It broke out right here, kind of hit some resistance at that 40-week, and is easing back. And on the ease, there really isn't a lot of volume right here, so, you know, I'm keeping my eye on it. But if it breaks this downtrend, I mean, I think this is heading higher, and I think this is going to take out the 200-day or the 40-week moving average. So Fitbit's kind of something you might want to keep your eye on just a little bit. And last but not least, is it RNGR? It's kind of an oil stock that I think could complete a weekly upside reversal pattern. But it's Thursday, so you gotta wait till Friday at the close. Is this Ranger Energy Services? I mean, this trading tight. I was loving this. I was about to buy it, and I'm glad I didn't, because, you know, something happened. I'm sure, you know, Wall Street didn't see something they liked. Saw something they didn't like, and now it's just in free fall mode from, you know, 1450 to 850. But it's the support stepping in, so I'm keeping my eye on this above average volume, because if volume ticks up to be above average, then you have a bottoming pattern complete. So it's just kind of something that you want to keep your eye on, especially if we are in just an energy pullback and it doesn't take another leg down, which I'm going to wait a couple days before I make that determination. Or even a week, but, you know, something to look at. So let me know if you have any questions. If you have any chart requests for next week, just email them to me at steven@thetradersplan.com on Wednesday, because I typically do my webinar recording on Thursday. I hope you have a great week, and we'll talk soon.